The numbers flashing on the screen right now tell a very specific and, frankly, aggressive story. We are looking at Hyperscale Data Inc., ticker symbol GPUS, sitting at exactly 0.23 USD, down roughly 0.0068 or 2.86% on the intraday session. If you are watching the tape, you are seeing a classic battle at the $quarter mark, where every fraction of a cent represents a massive percentage swing for the day traders involved. But if you just glance at that red percentage and think this is just another microcap having a bad Tuesday, you are missing the forest for the trees. The expectation here, the lazy narrative that most of Wall Street is running with, is that this is just alt alliance with a new coat of paint, a company known for dilution and complex holding structures, simply pivoting to the buzzword du jour of artificial intelligence to keep the lights on. That is the expectation. The reality, however, is significantly more nuanced and potentially explosive. What we are actually looking at is a company that has quietly transformed its balance sheet into a leveraged derivative of the Bitcoin market, currently holding a digital asset treasury that, by some calculations, rivals its entire market capitalization. This isn't just a tech stock anymore. It is a mathematical anomaly trading at 23 cents. When you look at the price action today, that drop of nearly 3% feels heavy, but you have to contextualize it within the volume. We are seeing tens of millions of shares change hands. This isn't a stock dying in the dark. It is a stock being wrestled over in broad daylight. If you open your Fidelity mobile app or check the charts on your Interactive Brokers trading platform, you will see a volume shelf that suggests a massive amount of accumulation is happening right at these levels. The retail crowd, often trading through the Robinhood app, sees a stock under $1 and thinks lottery ticket. But the institutional flows we are seeing suggest a more calculated bet on the underlying assets. The tension here is palpable because the market is trying to decide if it should value GPUS as a struggling legacy holding company or as a high-performance data center play with a massive crypto kicker. The disconnect between the stock price and the book value of the assets, specifically the Bitcoin treasury and the Michigan data center infrastructure, is the kind of inefficiency that value investors spend decades looking for. Yet it is terrified of the dilution risk that hangs over the stock like a storm cloud. Let's pull apart the recent movement because it tells us everything about the psychology of the current shareholder base. The stock has been hammered down from higher levels, and today's action is a continuation of that selling pressure, likely driven by the company's use of at-the-market offerings to raise capital. This is where the rubber meets the road for anyone using a self-investing strategy. When a company sells new shares into the open market to raise cash, it suppresses the stock price in the short term, creating the red ink you see today. However, and this is the critical contrarian take, they're using that cash to buy Bitcoin and high-end computing hardware, like the Nvidia H100s and Bitmain S21 miners. So, while the share count goes up, bad for price, the asset value per share is arguably becoming more robust, good for value. Most people using Schwab Intelligent Portfolios or similar automated tools won't touch a stock with this kind of volatility. But for the active trader, this dilution for assets swap is the entire thesis. You are essentially betting that the management can buy Bitcoin and GPUs faster than they dilute the equity. It is a race against the printing press. And right now, at 0.23, the market is betting they might lose. But if Bitcoin makes a run to six figures, this entire equation flips upside down instantly. When you're sitting there with your morning coffee, wondering why a company named Hyperscale Data is trading for loose change, we have to look at the business model itself. This is not a simple lemonade stand. Formerly known as Alt Alliance, the company rebranded to Hyperscale Data to reflect a strategic pivot toward the two hungriest sectors in the global economy: AI data processing and Bitcoin mining. They own a massive data center facility in Michigan. This is real estate, concrete, power, and cooling. In the world of Nvidia stock dominance, where everyone is screaming for compute power, having a facility that can actually plug these machines in is a license to print money. Theoretically, the constraint is capital. It costs a fortune to fill a data center with Nvidia H100 chips. We're talking about tens of thousands of dollars per unit. This is why you see the stock struggling at 0.23. The market is skeptical that they can fund this expansion without wiping out the current shareholders. However, they have a secret weapon, or perhaps a double-edged sword, which is their Bitcoin treasury strategy. They have explicitly stated a goal to hold a massive amount of Bitcoin on the balance sheet, similar to the strategy employed by MicroStrategy, albeit on a much smaller, riskier scale. When you invest online in GPUS, you are implicitly taking a long position on Bitcoin. If crypto winter returns, this stock could suffer immensely. But if we see a crypto supercycle, the leverage on this 23-cent stock could be astronomical. It's a high beta play. This is why you see it moving in sympathy with the broader crypto markets, sometimes even divorcing itself from the performance of the Nasdaq or the S&P 500. It's unique. It doesn't fit neatly into the buckets you find on investment help sites or the standard categories in Fidelity mutual funds. It is a hybrid, part real estate developer, part tech startup, part crypto hedge fund. Let's talk about the technicals for a moment because they are screaming for attention. On the daily chart, 0.20 has acted as a psychological and technical floor. We are hovering dangerously close to that. If you are a technical trader using the SoFi Active Investing platform, you are watching the Relative Strength Index, RSI, very closely right now. It's hovering in oversold territory, which often precedes a bounce, but oversold can stay oversold for a long time when a company is diluting. The moving averages are all trending down, which is the reality checking the expectation. The trend is your friend, and currently, the trend is bearish. However, the volume spikes we've seen in the last few weeks are anomalous. They suggest that someone is soaking up the supply. Is it a large fund? Is it insiders? Or is it just a massive rotation of retail traders on Robinhood crypto desks, trying to arbitrage the difference between the stock price and the Bitcoin holdings? The spread between the bid and the ask is tight, meaning there is plenty of liquidity, which is rare for a stock at this price point. This liquidity allows you to enter and exit sizable positions without moving the market too much, a feature that appeals to the day trading crowd. We also need to discuss the broader macro environment. We are living in a time where energy is the new gold. AI data centers consume power at a rate that the current grid can barely support. Hyperscale Data's Michigan facility is valuable not just because of the servers inside, but because of the power contract attached to it. In the realm of Fidelity ETFs that track utilities or infrastructure, there is a premium being paid for power access. GPUS has this. Yet the market caps it at a valuation that seems to ignore the replacement cost of that infrastructure. Why? Trust. The market has a trust deficit with the management team due to years of pivots and financing deals that hurt early investors. This is the smart friend warning. Buying this stock is a bet that management has finally found the winning lane and will stick to it. It is not a set it and forget it play for your Fidelity IRAs. It is a position you watch like a hawk. I want you to pause for a second and think about your own portfolio. Comment below how many shares of Hyperscale Data you currently hold, or if you are staying on the sidelines until they prove they can stop the dilution. It's fascinating to see the average cost basis of the people watching this, so let me know in the comments. Now, getting back to the analysis, we have to consider the Nvidia stock effect. When Nvidia reports earnings, or when the CEO speaks, the entire AI sector moves. GPUS effectively acts as a small boat in the ocean of Nvidia's wake. If the demand for AI compute continues to grow at this exponential rate, the overflow demand will trickle down to smaller players like GPUS. They don't need to be Amazon Web Services or Microsoft Azure. They just need to pick up the crumbs of demand that the giants can't fill fast enough. There is a massive shortage of rack space for high-performance computing. If GPUS can bring their capacity online faster than their competitors, that 0.23 price tag will look like a historical error. But that is a big if.